Good morning. For the last couple of months, I've been putting the view that I think the beginning of a new up move in commodity prices. There are two ways you can approach that. One is the simple argument that we're at the beginning of an extended period of rate cuts by the Federal Reserve. That's already started. We'll have a further 25 basis point rate cut in November and another 25 basis point in December, and those rate cuts will continue as we go through next year. And as a result of that, the US dollar will fall. You'll see the DXY, the index of US dollars, continue to decline. And then after a lag, what you will see is that will really start to bite with commodity prices, and commodity prices will go up. So that's the simple argument in terms of the world trade cycle. But this morning, what I want to look at is the structure of demand and where I think the structure of demand will be coming from. And for that, what I want to do is look at not just the Chinese steel industry, and it's really not the domestic economy that I'm interested in China. What I'm interested in is the very rapid growth of Chinese steel exports and where those exports are going to. So for the discussion on the domestic demand, which is, like I say, I'm only going to briefly touch on, I rely on a paper that's published by BHP. But for the stuff on Chinese exports, I'm relying on the US International Trade Administration and their statistics that they've got on Chinese exports. In the last year of which we've got data, which is 2023, China produced a touch over 1 billion tons of steel. I mean, imagine how much that would hurt if you dropped it on your foot. Domestic demand was 911 million tons, and that's up 50% from the 609 million tons produced 13 years ago. Now, what's interesting about that, and I'm referring to this BHP paper, is that the structure of domestic demand has changed. We think of all of that steel going into buildings. But what the paper this BHP paper points out, that back in 2010, 42% of the steel was going into buildings, but that has fallen, pretty much reversing those numbers. From 42 has fallen to 24. So building demand is a much smaller proportion of steel demand in China. What has changed dramatically is there's a lot more building of machines and machinery in China, and that has generated a change in demand from 20% of total production 13 years ago to 30% now. So the acceleration of that, and there's a acceleration of spending on infrastructure from 13% to 17%. But it is true that the Chinese economy is slowing down. This year, the Chinese government said they were going to grow at 5%, but the International Monetary Fund in April said that wasn't going to happen. They were going to grow by 4.6%, and the International Monetary Fund are closer to it than the Chinese government. And that number that the International Monetary Fund is forecasting drops away year by year through to the end of the decade to about 3% flat out. But what's really interesting, as that's happening, there's a dramatic increase. There's still a growth in demand for Chinese steel, and that's because there's been a quite remarkable increase in exports of steel. And it's that one that I want to look at now. And what I want to look at is the top 10 markets for Chinese steel exports. Now, these are not countries you would think of. You would think of, big demand would go to places like the United States, or it would go to maybe Germany, or or France, or someplace like that. But that's not where the growth in the world economy is. The growth in the world economy is in a place north of us called the Indo-Pacific. The Indo-Pacific name came from Shinzo Abe, who was the longest serving prime minister, Japanese prime minister since World War II. sadly no longer with us. So, and the fastest growth in last year's data was a country called Vietnam, and Vietnam absorbed 9.2 million tonnes of Chinese steel, which is 10% of total exports. South Korea absorbed 8.4 million tonnes, which was 9% of exports. Thailand absorbed 4.9 million tonnes, which was 5.3% of exports. And the Philippines, 4.8 million tonnes. That's not the United States, it's not Germany, it's not France, it's countries north of us which are using all that steel because their growth rate is so strong. The Philippines absorbed 4.9 million tonnes. Indonesia absorbed 4.2 million tonnes. Turkey, not to the north of us, but to the west, absorbed 4 million tonnes. The UAE, 3.7 million tonnes. And India, even though it has its own steel manufacturing industry, which is growing incredibly rapidly, they absorbed 3 million tonnes. What I want to do now is go in some of those countries where we saw that rapid demand, look at growth. And I want to look at 4 of them and what the growth is and what the size of those economies actually are. So Vietnam, which had the strongest growth rate. The point about Vietnam is that Vietnam is where what's happened in China is wages have gone up so much that they've been priced out of them. They're pricing themselves out of the manufacturing business. And a lot of that manufacturing is now using to Vietnam. So is now moving to Vietnam. So what you're having is the rollout of factory building in Vietnam as manufacturing moves there from China. Now, what's really interesting is that Vietnam has 100 million people. The size of its economy is $500 billion. And that economy grew by 6.9% this year. That's the kind of growth rate that China used to have. And the IMF thinks it's going to grow by 6.9% next year as well. Another country is the Philippines. The Philippines has 117 million people in it. It also has an economy of just over $500 billion. It grew by 5.7%. It's growing at 5.7% this year, and the IMF thinks it's going to grow by 5.9% next year. Indonesia is an enormous country, 280 million people, almost as many people as the United States. It's got a income of $1.5 trillion. And it grew at 5% this year, still a touch faster than China, and will grow 5.1% next year. And it'll keep growing at that because its population has continued to grow, unlike China. India, of course, which is the big guy in the Indo-Pacific, it grew by 6.9% this year. It'll grow by 6.7% next year, according to the IMF. It, of course, has a population of 1.4 trillion people, bigger than China, and its economy this year was $3.9 trillion. And I compare that to a little country in the South Pacific, a small open economy, as economists say, which has only 27 million people in it. You're right, Australia, and we have an economy of $1.8 trillion. But what you've got here is structurally you've got a position. In terms of the commodity recovery, what you've got is a financial story, which is pretty obvious. The Fed is going to cut rates, the US dollar will fall, after a lag commodity prices will go up. But what's really important is that this commodity market has strong structural demand. And that strong structural demand is coming not from strong growth in China anymore, but from very strong growth in the Indo-Pacific, particularly strong growth in Vietnam, particularly strong growth in the Philippines, strong growth in Indonesia, and of course, the big guy on the block, strong growth in India.